In this video, we're going to look at why interest rates and the money supply are linked and always moving in opposite directions. Let's dive in. So when it comes time to understanding monetary policy, we're going to talk about interest rates or money supply changing, which then will have an impact on investment, consumption, net exports. And when we think about those 2 points, whether the whole story starts with a change in money supply or a change in interest rates, it's going to end up having the same overall impact. We'll see later on that typically different countries will use a change in interest rates instead of a change in money supply because it's just easier to explain to the public, to understand, to see what's going to happen, see the end implications. And also changing interest rates will automatically change the other interest rates in the economy, and that's going to have a quick impact. Whereas changing money supply, if the money demand curve changed at the same time, it's a little bit more vague on what's going to be the impact on actual changes in interest rates. But let's just for now understand why these two things are linked. So in this class, you've seen a graph that shows interest rate on the vertical axis and the quantity of money on the horizontal axis. And money supply is seen as being vertical, completely vertical. And the reason for the money supply being completely vertical is because we say that the amount of money that's available in circulation is a combination of a few things. And the main things are the amount of money that the central bank prints out, that puts into circulation. So paper bills, coins, that would be based on that partly. And then the other big part is the money multiplying process done by commercial banks. So the money multiplying process essentially from the idea that banks only keep a fraction of the deposits as reserves and they loan out the rest. So it creates more money, separate video on that. But from that, you can see that there is a mixture of money being available that's supplied either through the initial process of printing those paper bills and those coins or through the second process of money multiplying by commercial banks. But in any case, that amount of money that's in circulation is not dependent on the current interest rate. And that's why we say it's vertical. And when it's vertical in the graph, it means that attribute, that thing, is insensitive to whatever's on the vertical axis, in this case, interest rates. And then we have the money demand curve that is downward sloping, and that money demand curve can move around depending on money needs and all that. Go through that in a separate video. So if you start from that initial basis, if all of a sudden the government were to increase the amount of money in circulation through printing more money, well, the money supply for the money multiplying staying fixed will shift to the right. As it shifts, it's going to lead to a new equilibrium intersection point between money supply and money demand, where interest rates are lower. So that's quite easy to understand how as money supply increases, the interest rate falls. So a lot of my students understand that part. They don't understand the subsequent part, and I could understand the confusion of why we can drop interest rates and then we'll have a greater amount of money supply. And there's a question that appears in one of the quizzes that talks about this idea that money supply is insensitive to changes in interest rates. So how does that work? Well, as I just said, the actual curve is insensitive to changes in interest rates, so it doesn't move due to changes in interest rates. But the thing that we have to understand is when the Bank of Canada lowers the bank rate, and then that has an impact on all the other rates in the economy, then there's something that's going to happen that's going to lead to an increase in the money supply. So let's just kind of understand the basics of it. We don't have to go through the whole scenario, but just the basics of it. Bank of Canada target rate is, let's say, 4%, and it drops down to 3.5. So when commercial banks see this, they're going to lower their prime rate, they're going to lower the rates on variable mortgages and and other things like that vary over time, lines of credit. And as that happens, consumers will typically borrow more, and banks will be also happy to keep less reserves if the interest rate is lower, because you keep reserves to make sure you don't run out of money in the overnight markets and that you end up owing a higher interest rate to another bank that you may borrow from. But if the rates are lower, well, running out of money, that opportunity cost is lower as well. So a lot of these commercial banks will actually start loaning out more, which kind of coincides with the idea that, well, consumers and businesses will probably want to borrow more at lower interest rates, because that's just how it goes. So interest rates have fallen, banks lower their rates and keep less reserves. And through this process, more people borrow money and there's more money multiplying process. So although there hasn't been new coins or currency issued with that same kind of initial scenario, now we have a greater money supply because of those lower interest rates. So this story started with interest rates falling, which led to more money being available, more money being in supply. You could also see it as the central bank increasing the amount of money in circulation, which will then have an impact on lowering interest rates. It doesn't really matter which one we start with. We just have to understand that they're both linked. It's impossible to lower interest rates without increasing the money supply. And same thing as increasing the money supply without it having an impact on interest rates. And as much as that is clear and true, we have to understand that the actual money supply curve is insensitive to changes in interest rates. Like I said, what made it change was not the change in interest rate, but rather the reaction to this change in interest rates by commercial banks that led to a greater money multiplier and a greater overall money available in circulation in the economy. So hopefully you understand the link between those two, that interest rates and money supply are always moving in opposite directions, and that you can start from one or the other. It doesn't really matter. Things will adjust over time. And typically speaking, central banks will always start with that interest rate target, and things will evolve afterwards. And just because it's easier to understand, it's quicker, go straight to the point. So hopefully that clarifies how this money supply interest rate relationship works. Have a good day. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real life examples. Have a good day.